Good morning or good afternoon. Just admitting people. Give me a quick second here. Admit. Admit. Give me just a quick second. I'm just admitting people. Admit. Okay, so good morning, good afternoon, everybody. Thank you for joining the ICANN Thursday trainings. Welcome. A bunch of names that are familiar, and I think we have a couple of new people, so welcome. So we do have a lot to get to today, and I definitely want to be mindful of time. Please, if you have things going on in the background, be mindful of your background noise. And if you have questions, please feel free to ask. And if you're typing in the chat and I don't see it, please feel free to jump in. I very much like class participation. So I've said for a while that we need to have a discussion about what exactly is life insurance and how does it work and how does the banking build work. I've gotten that question quite frequently, and I would like to go through that with everybody today. So I'm just going to bring up a quick PowerPoint, bear with me for 1 second, that I put together. Where's my slideshow button? From beginning. 1 second. Admit. Okay. 1 second, having some technical difficulties. And my slideshow disappeared. 1 second. Guys, if you have background noise, please be mindful of that. Okay. From beginning. Okay. Sorry, guys, having some technical difficulty sharing my screen. Share screen. Share. Okay, can everybody see my PowerPoint?
Yes.
Okay, thank you for giving me feedback. I'm having some trouble with it today. I don't know why. So today I want to talk about understanding the different types of life insurance and how they fit into the scheme of things. And something else that we're going to discuss in a couple minutes is really the cost of a life insurance policy. So just to give a little bit of background for this, circa 1986, the federal government changed the rules on how life insurance is purchased. Unlimited premium can no longer, from this point forward, which today we are after that, can no longer be put into a life insurance policy. There have been parameters that were set to qualify an asset as life insurance. Some of these tests include the 7-pay rule, TAMRA, etc. And premium for death benefit is always based on age and health, but the premiums are set by the insurance companies based on government parameters. That being said, now we're going to take a look at the types of different policies and how they compare to each other. So let's say we want $100,000 death benefit, and that is what actually is important to us, that we're going to have $100,000 death benefit. In theory, you could pay $10 for that policy per month, or you could pay $150 a month for that policy. But there are other things to consider. So we're starting with this line right over here. This is our annual renewable term line. This is the cheapest form of death benefit available. And with an annual renewable term, it is going to do exactly that. It will renew every year, and the premium is going to go up every single year because you're getting older. So this group right here, this is our term window. So it's more expensive than annual renewable term, but it's level for a period of time. So this includes 5-year, 10-year, etc. Then we have our GULs, guaranteed universal life. So basically, this is term insurance that is guaranteed to age 121. And the reason I'm comparing it to term insurance is because you have to pay premiums every year. You will have coverage until age 121, but you have to pay the premium every single year. There's no such thing as a paid up option, and there's no cash value in the policy. So over here, I know we're skipping over, but it'll make sense when we come back to it. This is our MEC line. So 1 cent over this line and the policy becomes a MEC, which means it's a modified endowment contract and is therefore no longer classified as a life insurance policy. It is now a taxable asset. So this side of the line is where whole life lives. It is the more expensive of the spectrum. You could be paying $150 a month for the same $100,000 death benefit, but it is level and it's for that person's whole life. That being said, so in this space, we have universal life, IULs, variable ULs, and something I will say about variable ULs is that most of us do not have the licensure to write these, but for those of us that do, these are dangerous because the value is primarily based on the market, and in a bad market, you could lose the policy. So just be mindful of that. And now we have this line here. In policies that are built between this line, if you can see my mouse, and this line, which is this red line here, policies built in this space can eat away at the cash value to pay the expenses in the policies in bad years. So basically, the policy has the potential to lapse if the cash value depletes. Then we have the money column. And in the money column, your premium will pay the full expenses of the policy without touching the cash value and thus can weather a bad year. So policies built in this space over here could include universal life, IUL, whole life, because these are always building cash value because the expenses are paid by the premium. That being said, you know, the cost of the policy is in terms of universal life and IUL, the internal cost of the policy is always increasing as the insured ages. So that could create a problem in a down market. So now that we have a basic understanding of how various life insurance policies function in relation to each other, I want to talk about banking for a quick second. So with banking, we know that we need to have cash in the policy, right? Yes?
Yes.
Okay.
Yes.
So we know we need to have cash in the policy because that's how banking works. So we can eliminate term and GULs because those don't have cash value, correct?
Correct.
And variable ULs are also written on market fluctuation, which most of us can't even write those anyway. So we can eliminate that as well, correct?
Yes.
Great. And we know that we can eliminate anything that would be considered a MAC because we want our bank to be untaxable, correct?
Correct.
Awesome. So that leaves us with ULs, IULs, and whole life policies, right?
Yes.
So in theory, an IUL is always going to outperform a UL. So we could eliminate a UL and now we're left with IULs and whole life. That being said, what is the big primary difference between an IUL and a whole life policy?
The guarantee is there.
What was it?
Something guarantee is there. You know, cash value and
Ding, ding, ding.
premium.
Yes, exactly. An IUL has a guarantee of 0, meaning that you're not losing money. So if if the IUL is written in the money column, meaning that your annual premium is covering the cost of the internal expenses of that policy, the guarantee is that the policy won't lapse. However, to use it as a bank, we need to know precisely how much cash value we are going to have at any given time. Because our clients are trying to do things like pay for their children to go to college. They want to know that they can buy a new car every 10 years. They want to know that they can go on vacation. They want to know that they can retire at, say, 65 years old, right?
Yes.
So what happens with an IUL if we are trying to use it as a bank?
Same
It
thing.
grows in cash. The cash accumulate. You have to overfund it.
We
Well,
never know.
there's a limit to how much we can overfund it, right?
Yes.
Before it turns into a MEC.
Yes.
So to use an IUL as a bank, we can't guarantee that we are going to be able to hit those milestones, right? We don't know that there will be enough cash value in the policy to send your kid to college, to retire when we want, right?
Right.
We can't guarantee those things.
Right.
With a whole life, we can.
Yes, definitely.
So that is really the 10,000 foot view of how the various types of insurance function in relation to each other. Because keep in mind, all of these policies had a $100,000 death benefit. But for the ART, we might have been paying $10 a month. But for the whole life, we're paying $150. So that being said, what is the actual cost of the policy? Okay, so for that, I'm going to stop sharing for one quick second so I can bring up some other stuff that I have. Oh. My apologies, I have. Okay, so for everybody who just joined us, I apologize. I had a bunch of things open and did not see the waiting room. Email me to get the replay of this training because I just went over a couple of things that were very important. So email me and I will send you all the replay. So that being said, we're going to build a policy, right? So let me just bring this up. Okay. So while that is opening, I'm going to share. Share screen 3. Share. Okay, so can everybody see my Life Plan 360 software?
Yes.
Okay, awesome. So
What made you think that was in the living room?
Because it wasn't in the kitchen.
okay, so this is, I believe, the family that we were building out the last time we went through the software. Okay, so we're gonna look at this. So how do we go about building them a bank? How do we do that?
So,
Anybody?
Will we ask about their liability, how much they owe? Like,
Okay, so we've already built the plan.
okay.
How do we build them a bank? The PUAR. Awesome. Okay, so that
What
is
was that?
one piece of it, right? So I'm
I
gonna.
didn't hear that word.
I'm sorry.
I didn't hear what you said. Something in answer. What was that?
Oh, in the chat, somebody put the PUAR, the paid up additions rider. And
Okay.
yes, that is an important piece to this, but we still have to break this down into, because we have two spouses, right? So we're trying to cover their whole life against any eventuality, which includes loss of income due to either health reasons or death. So guys, just please mind your background noise. So I have a little tool that I have created over here. I'm gonna, okay. That one. Okay. So what we have here is the income of person one was, one second. Admit all. So the income of person one is 120,000. So that's what we're put in here. 120, I think that's enough zeros. Yep. And person two is 70 right here. One second, we're having some, bear with me a second. Sorry, Excel is being weird. Please bear with me, we have technical difficulties. Okay, so we're putting 70,000 in here. Is that enough zeros? Yes, it is. Okay, so we know that our household income is $190,000. And this is going to give us the percentage of our household income. So our annual contribution, if we scroll up, is $67,596. So we're going to put that in here. $67,596. And what was our one-time contribution? Our, yep, 43,730. Okay.
Mhm.
So, basically what we have going on is that the percentage of our household income for the first person is 63% and the second person is 37%. So this, I believe, was a person that we made up. So I'm going to adjust this just slightly because this is not an actual client, and just so that I can show you that it will in fact work, we're going to say that this is 83. We're going to say that their annual their one-time contribution is $83,000, just so that I can show you how the build would work, because to use the premium deposit fund, it has to be an annual contribution. So that being said, this breaks it up. So our annual contribution for each person and our one-time contribution for each person is already built out for us. So now we're going to come over to Foresters, and we're going to move this over slightly so that we can actually see what we're doing. Okay. So log in, because it logged me out. So illustrations. Okay. So we're going to go to the Advantage Plus 2. And our clients, I looked it up a minute ago, were 40 and 42 respectively. So we're saying that he is 42, so that would be 1980, I think. Yep. Okay. And we're going to say that he's non-tobacco. I always run these non-tobacco standard unless they tell me that they are in fact smokers or have other health concerns, because it's always easier to come back and say, good news, you actually came back preferred and we need to rerun the illustration. You'll actually have more money than it is to run it at preferred and be like, so you actually only came back standard? Much different conversation. So death benefit and funding will come over here. So he is person one, right? So, and we need to put in the right sol, which I always forget to do this. It's medical.
Mhm.
Now we can go over to page 2. And you want the FPUA permanent term blend non-MEC face solve. So a bank is a life insurance policy that is premium driven as opposed to being death benefit driven. Does that make sense?
Say it again.
A banking build is a life insurance policy that is premium driven as opposed to being death benefit driven.
Yes, makes sense.
So we've just figured out in here what our client has for money to build their bank with. So we're also trying to illustrate the cost of insurance, which I will get to. Bear with me. Wrong tab. Okay. So we now know how much premium we have to build this bank with. So we're going to say that it's an annual premium. And our annual premium is $42,700. We're just going to round. $42,700. Okay. And the riders. Come on. So in here, we're going to put a 20-year term on it. Does anybody know why I'm putting a 20-year term on it?
To have more of a face amount?
It's not necessarily that it will have a higher face amount as opposed to a 10-year term, but the 20-year term will protect them for a longer period of time. When that term drops off, that paid up additions rider has purchased more whole life that they can't outlive.
Okay.
So they're in their 40s, and the reason that they came to us in the first place was so that they could send their children to college. So should something happen to them while their kids are still in the house or still needing that support, they're still covered. So that's why I usually go with the 20-year term. And
Okay.
also, we have this annual lump sum amount, which we're going to drag over here. So for person A, we're going to say that that is $3,400 for years 1 through 3. Nope, not 38, 1 through 3. Okay. I'm going to make this bigger so you guys can actually see the whole thing. And now we're going to go to the at a glance. Okay. So year 1, we're putting in $46,100. We have a guaranteed death benefit of $1,118,000. Year 2, we're putting in the same amount of money. We have $1.2 million death benefit. Let's come down to year 10. So at year 4, now we're only putting in our annual premium because we've exhausted that lump sum. But the death benefit continues to increase. At year 10, we're putting in $42,700 per year. We have a $2.2 million death benefit. And we have a $458,000 guaranteed cash value. Okay. Everybody still with me?
Yes.
What have we put into this policy? Why is my computer being weird today? 1 second. I need a calculator. So I want to show you guys this. Okay. So $42,700 times 7 years plus 46,100 plus 46,100 plus 46,100. Does everybody know why I did it that way?
No.
Okay. So we're trying to figure out how much premium we have put into this policy in the first 10 years.
Okay.
So years 4 through 10, we put in $42,700. So 4, 5, 6, 7, 8, 9, 10. That's 7 years. So we multiplied $42,700 times 7. And then the first 3 years, we put in $46,100. So I added that amount of money 3 times. Does that make sense?
Yes.
So basically what we've put into this policy in the first 10 years is $437,200, okay?
Mm-hmm.
So we're gonna take a look at the guaranteed cash value in year 10. Can anybody tell me what that is? It's right here.
Okay, it's I think it looks like 458,000. Because I can't really see it. It's so small.
Oh, no.
It is $458,000.
Yes.
Okay, 458,000. Okay.
Yeah.
So that being said, what was the cost of insurance to
So,
this client? How much did it cost them to have a $2 million death benefit?
Nothing,
Nothing? Why?
because it's offset with the cash value.
Exactly. So we have $458,000 of leverageable cash value. And we've put in $437,000. So we have everything that we've put into it at year 10 plus some, and all of it is leverageable. But we still have that 2-point-something million death benefit should something happen. Right?
Yes.
So at the break-even point, which if done properly, sorry, 1 second, letting people in. At the break-even point, the asset becomes a true asset, and the death benefit is a fringe benefit. Does that make sense?
What kind of benefit is that? French?
Say that again.
What's the word you're using? What kind of benefit?
The death benefit becomes a fringe benefit.
French benefit. I never heard that. Okay.
A fringe benefit is kind of something that you get but is not expected. It's kind of just extra.
okay.
So this is when this bank becomes a true asset, because we're not, the death benefit is not costing us anymore, because we have every dime that we've put into it as a leverageable asset. Does that make sense?
Yes.
Yes. So I have a question.
What product is this?
This is a Forester's whole life with a term rider and a paid up additions rider.
Okay. Thank you.
So I have a question. So even with the first 10 years of premium, are they doing a lump sum or they just paying it out monthly?
They're paying it out monthly.
Okay.
As far as the client's budget is concerned, they are paying into this monthly. So they, as a family, where's my tab? They're paying $5,600 a month for both of their policies. And this policy was only on the husband. We haven't run the policy on her yet.
Okay.
So they theoretically will have a whole lot more money than this, because it would be added to hers. But just for you guys to see how it works, this is how we build it.
Mhm.
So that being said, the way the premium deposit fund works is if they have a large enough lump sum that they can pay their annual premium all at once, we will do that. And then whatever is left over, we can use to build space, so that if they get a raise or a bonus or whatever else, they can still deposit that in their bank and not turn the policy into a modified endowment contract.
Okay.
Does that make sense?
Yes.
So the way they pay monthly is that we have paid the premium annually with that lump sum. That being said, the client now continues to pay that premium deposit fund monthly. So they pay month 1, month 2, month 3, etc. And then at the anniversary, that premium deposit fund now has 12 months of premium that they have put in, right?
Mhm.
What does 12 months of premium equal?
37? Oh, no. Okay.
Say that again?
Oh, no, I didn't calculate. Okay, I'm sorry.
No, it's fine. You don't need a calculation. So what 12 months of premium equals is an annual premium.
No, that is actually more.
It's not.
Really?
So if you take the annual premium and divide that into 12 equal payments that they are paying monthly,
Then
the
96.
policy has the money to pay the annual premium. Does that make sense? So, okay, let me bring up a calculator. I'll show it to you. So
Kendra.
let's say,
Kendra,
yep,
I think they're getting confused with paying a monthly premium to the insurance company as opposed to putting the money aside, because monthly premiums, there's a finance charge, annual premiums, there is not. So that's where they're getting
Good point.
confused.
Yes, okay, so the premium deposit fund, what the premium deposit fund does is it holds premium deposits. So let's say your annual premium is $12,000. Because of that lump sum, we paid that $12,000 up front, right?
Mhm.
Yeah.
Okay, so now immediately after that, we've just set up this policy, month one shows up. We're now going to divide this $12,000 by 12 months.
1,000.
That's $1,000 that we are
Every month.
putting into the premium deposit fund on a monthly basis. So at the end of 12 months times 12, we're back to the $12,000. Is everybody still with me?
Yeah, I got it.
Okay, so the premium deposit fund is now holding 12 months of premium, which is an annual premium. And the premium deposit fund pays the policy. If we were to set this up as a monthly payment, it would have a slightly different premium. However, we can set it up such that the client feels a monthly payment, but the policy pays annually. And to do that, we use the premium deposit fund. Does that make sense?
Where is the money coming from if you don't use it? I mean, you don't put that one every month. How they're going to use the lump sum money for that payment?
So that is what we call policy funding. So when the policy is issued, we deliver and fund the policy. So the annual premium would be paid at that time. And then the premium deposit fund would also be set up at that time. So that is where we fund the policy, pay the full annual premium, put all of the rest of it into the premium deposit fund, and we set up an automatic draft such that the client starts paying, what is it, like 7%, whatever percentage of, let's see, 100 divided by 12.
So we say we
8.3%
paying the,
of their.
so
their
we paying
annual-
the whole money in upfront, right? That's what you're saying?
That's what the lump sum is used for, yes.
Okay.
So they get that added little bonus of the cost of insurance coming down just slightly, which builds their cash value faster. We can still get their entire lump sum into their policy. We're building space for them, and it still feels to them like they're paying monthly. But added bonus to you, you can't get a chargeback if they've paid annually. Does that make sense?
Excellent.
Okay. So that being said, I wanted to talk about the cost of insurance. So as we've said already with the whole life, the actual cost of insurance disappears at the break-even point, right? In a whole life policy?
Yes.
Okay. So now I want to show you what a term, excuse me, a term looks like. Smart UL, strong foundation, your term. So we're going to run a term. Yep, so this one's a medical. Male, aged 42. So same client, right?
Right.
And what did we have year one? We had a 1.18. Yeah, $1.1 million.
I would just say round it off to 1.2.
$1.2 million of death benefit. Okay. 12. And we're gonna say it's annual to get that discount, okay?
Mhm.
So how long is our term?
20 years.
Do we want to keep it 20 years? Do we want to make it 10? Do we want to make it 30?
How old are they?
This client is 42. How long do we think that they would want a life insurance policy for?
I would say 30 years.
30 years? Okay. So we'll say that it's a 30-year. And we're going to take a look at the at a glance. So our net death benefit is $1.2 million. It is a level death benefit, meaning that it is $1.2 million on day one, and it is $1.2 million at year 30. So year 30, well, year 1 and year 30, we are paying $3,500 a year for this policy, okay? And year 30 brings them down to age 71. So what happens to this policy if they live one day past that?
They have no
It's going
coverage.
to lapse.
The policy expires, right?
Right.
So what has this policy cost us? So we're
35,
gonna
74 times 20 or 30.
30, yep, 35 times 74 times 30. So we've spent $107,000 on this policy. But what do we have if we've lived one day past age 71?
0.
We've got nothing, right?
Yeah.
So what did this policy cost us?
A
Lot of money.
It cost us $107,000 versus, let's say in both cases, we die at age 72, okay? So we're gonna scroll down to age 72. And where's the death benefit column? Yeah, there it is. Age 72. Do we have that death benefit at age 72?
In the whole life, yeah.
Yes. Yes.
In the whole life? Yeah, we do. So we have $3 million of death benefit in the whole life, and we have
0.
nothing in the term life, right?
Mhm.
So what did the term life cost us again?
107,000.
$107,000.
Mhm.
What did the whole life cost us?
0.
It cost us nothing, right? Because the
Broke even.
actual cost disappears
Right.
because you have a leverageable asset.
Right.
So can somebody explain to me why whole life is expensive?
Because it's a guaranteed cash accumulation,
But if there's no cost, how is it expensive?
It's not expensive.
so it's not expensive.
It's just expensive putting the upfront cost in those early years. But every
Yep.
year it gets less and less.
Yep. But if we show that to clients when they tell us that whole life is expensive, okay, well, let's investigate that claim.
Mhm.
You know, let's play that out on both sides. Because even in the first 10 years of this policy, they're putting in $46,000 and $42,000 respectively. They still do have cash value that they can leverage if they needed to.
Right.
They may not have all of it,
Right.
but they still have something if they needed to, which is similar to home equity, right?
Right.
Yes.
Because you can only ever access 80% of your home equity. By law, you have to keep 20% of the equity in your home. Right?
Yeah.
How do you get equity out of your home?
You gotta take a loan. You gotta borrow.
How do you do that?
You gotta get approved.
You have to get approved Is there a cost associated with
Yes,
taking a loan?
Yeah,
yeah,
Yeah, there's all sorts of closing costs, right? So it is costing you to use your equity, correct?
yes.
Is there a cost associated with accessing your cash value?
No,
make a phone call.
I mean, it is still technically a loan, so there is a an interest rate associated with it. But here's the question. If you're paying a 4% interest rate, but you're making 5.5% on your money that you've already spent, do you care?
no,
Does it actually matter?
nope.
Because you're still making a positive arbitrage of 1.5% on money that you've already spent.
Yeah,
But whole life is expensive. That is probably the number one objection that you're going to get when meeting with clients. Has anybody had that experience? Anybody? That you're meeting with a client and they say, you say, well, what do you know about whole life insurance? And they say, oh, it's expensive. Oh, that guy I read a book by said that whole life is bad. Well, why is it bad? So that is a great way to address that issue. Literally show them the illustrations on both sides. Because it's kind of like, honestly, guys, this goes back to the poor tax. Has anybody heard of this?
what the hell? Oh, what kind of tax?
The poor tax.
No,
Okay. So there are two people, right?
yeah,
They both need boots for work. Okay.
Yep.
One of them makes enough money that he can afford the $200 pair of boots that's going to last him 3 years.
gotcha,
Okay.
right,
Person two doesn't.
right,
They can only afford the $80 boots
the Payless boots,
that are going to last 1 year.
right,
Okay. And eventually he gets promoted, right? And he's making the same amount of money as the first guy, right?
right,
But he is now in a mindset of, I buy $80 boots. What is that costing him?
$80.
$80 a year,
$80 a year.
right,
Versus, so what is that in 3 years?
$240.
It's $240 versus the first guy who bought one pair of boots in 3 years for $200.
right,
So over the course of 3 years, person two is spending an extra $40.
mhm,
And now he's stuck in that mindset of, I have to buy the cheap thing.
Mm.
That is the poor tax. We're
You're saying poor
conditioned
tax?
to think this way.
mhm,
So we are conditioned to believe that we need to buy term because it's less expensive and build money other ways. And whole life is expensive. But is it?
no. Not in the long run.
Right. But that is the poor tax effect.
Poor tax. How do you spell that?
Poor, P-O-O-R.
Oh,
Poor as
okay.
in poverty.
Okay, okay, thank you. Sorry.
So it's really all about mindset. I mean, when you're starting out, you can't afford to get filet mignon every Friday. You're lucky to get ground beef, okay? But as you make more money, you can do different things in your lifestyle that will affect your your health long-term or will affect your lifestyle. And maybe the initial investment is higher. But you have to take a look at the long-term benefits and what that cost is over time. And it's the same with life insurance and building a bank. Does that make sense?
Mhm.
Yeah, but we need
Yes.
money. Money is the problem, you know?
But have we done anything that is costing this client money? Did we tell
No.
them at all ever that they have to find money in their budget to do this?
No.
Nope.
Investment.
We took a look at the things that they are doing already. We turned their perspective on its ear. We found money that they are already spending and gave it a new job. And I know you guys have heard me say this before, but I'll say it again, that idle hands are the devil's playthings and idle money works the same way. It's Parkinson's law number 2, that expenses will always rise to match the available income. So we need to give our free dollars a job that is achieving our financial goals. Or those dollars will disappear and find something else to do and you will never see them again. Okay, so does anybody have any questions on this?
I'm good.
Okay. There are a couple of you who did your homework from last week. Thank you, and I'm very proud of you, and we will be chatting offline on how to work that out. I know a couple of you are still working on actually nailing your people down to get appointments. That being said, I now have your next homework assignment. The first homework assignment is to continue that out. Anybody who brings me the name of a client that they want to sit down with by this time next week, and actually has an appointment set with that person by November 1st, any business that comes out of that will be a 50-50 split. And the second piece of your homework assignment is before next week, I need you to send me a list of objections that you've either gotten when sitting down with a client or that you are afraid to get. And that's why you're not sitting down with the client. Because I really want you guys to have all of the tools that you need to sit down with clients. So always keep in mind that I leave it on the table that if you guys are not ready to sit with clients and you guys have clients that you want to sit down with, it's a great learning experience for you that we can sit on a call together with your client and they are still your clients. But I really want you guys to be prepared to eventually sit with clients on your own, which is why I want you guys to give me a list of objections so that we can address them next week. Does that make sense to everybody? I'm getting one thumbs up. Does anybody else have questions? Okay. So that being said, were there questions on anything for today?
No.
Okay, so I know several of you came in late and it may have taken a while for me to let people in and I apologize for that. So if people have missed part of today, send me an email and I will send you the replay. So we actually got through a lot today in less time than I thought it was going to take. I feel like I may have rushed through things. So if anybody has any questions, I'm going to hang out for a minute. If not, I think we've gotten through everything that I wanted to talk about today. We've covered, you know, how policies relate to each other in terms of term, GULs, universal life policies, whole lives, and MECs. And we went over an actual build of how to build out a banking policy and the cost of insurance. So if anybody has any questions that they think of, let me know, email me, what have you. Otherwise, continue to do your homework. And so for next week, send me a list of objections and that you'd like answers to. How do I approach this? How do I approach that? Let me know. And also for anybody who has clients that they would like to sit down with and they are ready to sit down with or are not ready to sit down with, let me know. If you can get an appointment before November 1st, get me their names before this time next week, and it'll be a 50-50 split on any business generated. So that is your homework. Any other questions, please feel free to reach out to me. If you need the replay, because I know several of you came in late, email me. With that, I should check the chat. I just realized that there's a bunch of stuff in here. Does the client pay premiums until age 100? They can, but they don't have to. I do not put a paid up date on illustrations unless specifically asked. Simply because you've now conditioned that client to think that they either have to stop paying at that date or that they will stop paying at that date. And you don't know that that's actually what they're going to do. So I never show that on an illustration. But yes, they can pay until age 100, but they don't have to. Where is the non-guaranteed column in a Forrester's illustration? Oh, let me share my screen real quick. Share screen. That's the wrong one. Okay, so the non-guaranteed column, guaranteed payment cash value, total cash value column. The total, can everybody see this? The total cash value column is with the dividends. So right here, if everybody can see my mouse. So if the guaranteed cash value at year 10 is 458, the total cash value based on projected dividends is 492, which really is almost 10%. So that's pretty good. Let's see.
So the total cash value is also the non-guaranteed side?
That is the non-guaranteed side. It's never not happened in the last 100 years, but by contract, I can say that the guaranteed column is guaranteed by contract. If you put in this amount of money over this many years, I can guarantee this. There in the last 100 years, there hasn't been a point that dividends have not been paid, but they're technically not guaranteed.
Okay.
Legally, I can say it is because it's never not been paid in 100 years. I personally don't, but there it is. I mean, I love pointing at this column and saying, I can guarantee that you're going to break even right here. And then it becomes a true asset. It's more likely to be this, but I can guarantee this. Make sense?
Yes.
Okay. 2 new messages. Email sent. Got it. Okay. Any other questions before we adjourn for the day? Okay, I take your silence as that we had a good class, and have a great weekend, guys. Do your homework, and I will see you all next week.
Thank you.
All right.
So Kendra, I do have a question.
Yeah.
So I was trying to get into the platform, the LP360, but I'm not able to get in. So I don't know, because I thought you get like that 30-day free trial, and then the next month you pay the $249. So can you assist me with that when you're have a minute?
Let me write that down. I will look into that.
Okay.
So you're looking to do the 30-day free trial?
Yes. And then I'm supposed to pick a plan. I wanted to do the LP360, and I think that's the $249 one. I think it's $249.
Yeah. It might be 249.
Okay.
So let me, so 249 for software. CC is having. Oh, I haven't put my email in the chat. That's awesome. So that's my email for anybody who doesn't have it. Cece, if you could email me with your contact info,
Yes.
just so I know I have it,
Okay.
and I will look into this and get back to you.
Okay. Thank you so much.
Yeah, and you see my email?
Yes.
Okay, good. Okay, any other questions before we adjourn? Okay, great. Well, have a great weekend, guys. Don't forget about your homework, and I will see you all next week.
Bye-bye. Have a good one.
You too.